Welcome to the most dangerous moment in modern financial history. For the last 3 years, the mainstream media, geopolitical analysts, and doom loop economists have sung the same chorus: the US dollar is dying. But as of today, March 17, 2026, the reality on the ground has delivered a violent wake-up call. The dollar isn't dying, it is consuming. We are currently witnessing the largest short dollar trade in human history come completely unglued. From institutional hedge funds in London to commercial banks in Tokyo, everyone bet against the greenback, and now the bill has come due. Why everyone was wrong. To understand why the market is panicking today, we have to look back at the dollar milkshake theory. Imagine the global economy as a giant glass of liquid. This liquid represents capital, liquidity, and wealth. Every country has a straw in that glass, but the United States has the biggest, most powerful straw in the world. While other nations were trying to build their own glasses, alternative currencies, they forgot one crucial detail. The world is short dollars by design. There are over $13 trillion in dollar-denominated debt held by entities outside the United States. These companies and governments didn't just choose to use the dollar for fun. They are legally and structurally obligated to pay interest and principal in USD. When you owe someone $1, you are effectively short that dollar. You have to go out into the market, sell your local currency, euro, yen, yuan, and buy dollars to pay your debt. This creates a permanent structural demand that doesn't care about politics. The geopolitical catalyst. The Iran war, and the energy trap. Why is this squeeze happening right now? The answer lies in the escalating conflict in Iran. As of mid-March 2026, the Strait of Hormuz is effectively a no-go zone for global shipping. Over 12 million barrels of oil are currently shut in or blocked from reaching the market. In the past, an oil spike like this would have crippled the U.S. economy. But 2026 is different. The United States is now the world's undisputed leader in oil and gas production. While Europe and Asia are seeing their energy costs explode, with oil sustaining levels above $110 per barrel, the U.S. is insulated. This creates a deadly double tax on the rest of the world. 1. The energy tax. Foreign nations must pay more for the fuel required to run their factories. 2. The currency tax. Because oil is priced in dollars, they must sell their crashing local currencies to buy the very dollars that are getting more expensive by the hour. This is the milkshake in action. The U.S. is sucking the liquidity out of the Eurozone and Japan to pay for its own energy dominance. The technical breakdown, breaking through the resistance. If we look at the DXY, dollar index, charts today, the situation is grim for dollar bears. For months, the dollar was bouncing between a support zone of 100 and a resistance zone of 102. But as of this morning, March 18th, we have seen a definitive breakout. When the DXY breaks 102, it triggers what we call a liquidity vacuum. The next major resistance doesn't sit until 104 or 106. If the index moves toward 110, we are no longer talking about a strong dollar. We are talking about a global insolvency event. Every time the dollar surges, the S&P 500 takes a direct hit. There is currently a near-perfect inverse correlation. Why? Because institutional investors who are losing money on their short dollar bets are being forced to sell their winners, namely U.S. large-cap tech stocks, to cover their losses. The stock market has become an ATM for a world that is starving for cash. The central bank policy trap. The Federal Reserve finds itself in a hawkish trap. Market expectations for rate cuts in early 2026 have vanished. Fed officials are signaling that because of the energy-driven inflation spike from the Iran war, they cannot lower rates. Meanwhile, the European Central Bank, ECB, is in a nightmare scenario. Inflation in the Eurozone is soaring because of energy costs, but their economy is already in a deep recession. If they raise rates to save the euro, they destroy their economy. If they keep rates low, the euro collapses against the dollar. As of today, the market has realized the ECB cannot win. This is why we see record outflows from European assets into U.S. Treasury bills and money market funds. It is a flight to safety that paradoxically makes the world more dangerous. The end game. The Mar-a-Lago Accord. How does this end? Brent Johnson's theory suggests that the dollar will continue to rise until it breaks the global financial system. When the dollar becomes too strong, U.S. exports stop, and foreign nations default on their debt. We are likely heading toward a Mar-a-Lago Accord, a 2026 version of the 1985 Plaza Accord. This would be an emergency meeting where the U.S. agrees to artificially weaken the dollar in exchange for massive trade concessions from Europe and Asia. Until that meeting happens, the wrecking ball will keep swinging. Gold, silver, and Bitcoin are currently facing pressure because, in a true liquidity squeeze, people sell what they can, not what they want. They need dollars to survive the day. Portfolio strategy: protecting your wealth. If you are an investor watching this unfold on March 18, 2026, here is the playbook. Cash is king, but only USD. Holding USD-denominated cash or short-term treasuries is the ultimate hedge right now. Avoid the value trap in Europe. Don't be tempted by cheap European or Japanese stocks. They are cheap for a structural reason. Watch the 106 DXY level. If we break 106, expect a 10 to 20% correction in the S&P 500 as the squeeze enters its final, most violent phase. The re-entry point. The time to go all in on gold and hard assets is the moment the U.S. government signals they are ready to devalue the dollar. Not a moment before. The dollar milkshake is being served, and the U.S. has the only straw left. Stay vigilant, watch the liquidity, and don't get caught on the wrong side of the largest short squeeze in history.